But yeah, guys, if y'all are interested in you know, really digging deep into this stuff and learning as much, there's lectures. These are real lectures from the Columbia Business School. I mean, these are back 10 years ago, 13 years ago. But like I've listened to these two many times. Um, but this guy right here has these videos up here if you're interested. Now another guy I want to show you that is more this guy right here. Um, he's also a teacher, and he basically values businesses, and he will also value businesses that are hard to value, like he'll value internet companies and things like that. But if you I haven't listened to this guy in a while, but he's got a lot of very interesting information if you want to learn. Here's a picture of him. I mean, he's getting a little older, but he's a very smart guy. He's a very good investor, and he's um, and I know a lot of you guys are probably dividend investors. Um, Let me click on this. But I mean, if you're ever wanting to learn, watching a lot of these videos, reading some of these books, um, they're very good. I don't know why I don't hear anything.
Went bankrupt. It went bankrupt. It was a bailout, tiny by today's standards, one of the first US government bailouts of a publicly traded company. Chrysler came back with a new CEO called Lee Iacocca. And in 1984 or 85, Lee Iacocca invented a vehicle that we still curse him for, which is the minivan. The Dodge Caravan saved Chrysler as a company. It saved Chrysler, it brought the company back. This is my look at the cash flows. It's what's happening as Chrysler's recovering. So each year what I've done is I've computed the free cash flow equity. That's a white column. Notice it's much more volatile than what you see in dividends because it's a number that jumps around. The black column is the cash return to shareholders either as dividends or buybacks. Every time the white column is higher than the black column, that's cash accumulating. I've kept track of the cash accumulating the company. In 1985, Chrysler had close to a zero cash balance. By the time you get to 1994, Chrysler has an $8.5 billion cash balance. By itself, that doesn't sound like much, right? Apple has a $200 billion cash balance. But remember, it's all relative. That $8.5 billion cash balance at Chrysler was more than 30% of the company's overall value at that point in time. So Chrysler was 70% automobile company, 30% cash. Yes? In a recession. When you have a recession, you burn through cash, and they did burn through cash that year. They burned through about $500 million. So in 1994, Chrysler is $8.5 billion, 30% of the company's cash. It got targeted by an activist investor who said, you have too much cash. You got to return the cash. What do you think Chrysler's first defense was? We almost went bankrupt. We're a cyclical company. We need the cash. But embedded in this graph is a pretty severe recession. 1990 was a pretty severe recession. They did burn through cash, but they burned through $500 million in cash. So let me set up a math problem. If the last recession lasted 2 years and you burned through $500 million in cash, how long will the next recession have to last for you to need $8.5 billion in cash? The answer is really, really, really long. In other words, you're preparing for the Great Depression. That argument did not go well with investors. They said, that's too much cash. 2 billion we can understand, 8.5 billion. So then Chrysler came back with a second argument, and this terrified investors. You know what Chrysler said? We might need to do a big acquisition. Now, the history of acquisitions is everybody gains except for the shareholders of the acquiring company. So Chrysler shareholders were not impressed by that either. Long story short, this fight ended with Chrysler returning a big chunk of that cash to its investors. It then got bought by Daimler in one of the most ill-fated mergers of all time. And the rest, as they see it, is automobile history. What I'm trying to say is not all companies get treated the same way when they accumulate cash. Some companies are left alone. Some companies are, you see investors aggressively pushing. So today I'm going to bring up the word that I think drives how investors react to dividend policy, which is trust. Because when you leave cash in the hands of the company, who controls the cash? The managers of the company, right? If you trust the managers of the company, you're much more likely to let cash build up in a company. Whereas if you don't, you're going to say, give me my cash. It's not because you're greedy or selfish, you just don't trust them with your cash. So what determines trust? Will you listen to a man? Say, if I as a man say, come on, trust me, is that enough? No, probably not, right? You're going to look at my history. And the second is, if you don't trust the market, you look at the accounting numbers. Have they taken projects that earn more than the cost of capital? So the Jensen's alpha that you computed in section 2 and the return on capital versus cost of capital you did in section 5 both come into play. And if you look at those numbers and say this company has a history of picking good projects and not wasting my money, you can let cash balances accumulate in companies. And
I'm not no financial expert, but some of these jargons, return on equity, return on capital, free cash flow. I'm not sure what the E stands for. Equity, maybe?
Nobody's going to push back. In 1997, I went through and I looked through, at that time you had to look through the Dow Jones Newswires. There wasn't one investor who was complaining about the fact that Microsoft had the largest cash balance in history. You know why? What did they have to complain about? Stock went public in 86. By 96, one of the great companies in the world already. It delivered great returns to shareholders, great returns on projects. People trusted Microsoft in 97. But trust is fragile, right? All you need is a couple of actions on the part of management and you very quickly can lose trust. But in 97, Microsoft was trusted, they were allowed to accumulate a cash balance. 5 years ago, Facebook was trusted, Google was trusted by investors to build up cash balances. We can ask, do you trust Mark Zuckerberg with your cash balance now, especially with the metaverse plans? And you can see how quickly things can change. If you don't trust the management because they have a history of picking bad projects or delivering bad returns for you as a shareholder, then I think you're on completely legitimate ground saying, give me the cash back. If you own 1,000 shares and you get up and say, give me the cash back, what's the reaction of the management? Let's go away, right? But if you can get an ally in this fight, and this is where the activist investing base helps you, right? You're not big enough to make this noise, but if a Carl Icahn makes this company that has poor projects and you're building up cash, you're exactly the kind of company that's going to get targeted by activist investors. So in this box. If you're a company which is paying out too much in dividends and you're a bad project, you don't even know where to start because you have an investment problem and a dividend problem. And finally, if you're a company with good projects and you're paying out too much, you're doing double damage to yourself. So one thing, when you look at your company, make that assessment of, do I trust? Don't make it about everybody. By this point, you know enough about your company where I say, would I trust the managers of this company with my cash? Make it personal. And the answer is no. I think it's perfectly reasonable to say, we want some of that cash back as investors, either as dividends or as buybacks. You have a choice. So what I'd like to do is take my companies through a hypothetical annual meeting, and I want you to play the role of shareholders in this company, and I want you to make a judgment on whether you trust me. I'm going to play the role of a CEO. So let's start with Disney in 2003. Who is CEO of Disney? Michael Eisner, right? So you have a history with me, right? What's your history with me? That I've treated you like dirt for a decade, and I've done things, and I have a big ego, and I do things, and I said, trust me. Remember 6 years ago, I came up and said, trust me, I know what I'm doing, and I bought ABC, and it's paid off badly. So if you look at 2003, as a CEO, here's what I'm coming in with. I'm coming in with a return on equity that's been about 2% less than the cost of equity over the previous decade. I'm coming in with a stock that has underperformed my peer group. And I'm coming in with a plea that I want you to trust me with your cash, because I've also been building up a cash balance over this period of $3.5 billion. So I've built up a cash balance. I come in with you, come in front of you with a history that is not a great history, and say, trust me. What's your answer going to be? I wouldn't trust myself, right? I mean, this is a company where you can see how when CEOs in good times treat shareholders badly, how this comes back to bite them in the bad times. So when you have imperious CEOs who said, these are good times, how dare you question me? There will be bad times. In this case, Eisner's history essentially was getting in his way of, hey, trust me. So in 2003, Disney lost this battle. 2 years later, so in this case, you can see that the fact that Eisner is the CEO, you have a history with him, plays a role in whether you trust management. You can also see that the performance of the company is also affected whether you trust the company. It doesn't have to be 10 years. It could be just the last 2 years. In Facebook, it was just 2 years of bad performance. So when you look at a company, this ties back to your corporate governance section. We say, how much power do I have in the company? The answer was, I don't have much power. The CEOs essentially run wild here with a board of directors that's a rubber stamp. And you get to this stage, you say, I don't trust this management with my cash. 2005, of course, Iger got pushed out of Disney. I'm sorry, Eisner got pushed out of Disney and Bob Iger became the CEO. And remember I said for the first few years, Iger was the anti-Eisner. He essentially was, he brought in shareholder input, he changed the board of directors. So let's say so in 2003, Disney had zero chance of winning. They were forced to give cash back because they had no choice. But in 2008, I'm now the new CEO. You're still shareholders in the company, but things have changed. My returns on my projects now exceed my cost of capital. I'm earning more than my cost of capital. My stock has done much better than my peer group. My corporate governance scores reflect the fact that my board of directors is now more independent. And I now have gone back. So during that intervening period, between 2004 and 2008, Disney actually returned more cash than they had available because they were, in a sense, pushed into doing it. But as Iger, I want to retain more of that cash. So I come back to you and say, look, we've been giving you back more cash than we have available. But things have changed. We have new plans now. We want to build new theme parks, buy new movie studios. Remember, this was before they bought Marvel and Lucasfilm, so that was still coming. I need the cash. Trust me with the cash. Same company, 4 years later, but a different CEO and a different track record. You can see how trust can shift. In this case, when the vote was put to the shareholders, they were much more willing. It's not guaranteed, but you can see why when management changes and performance changes, companies can start to regain trust. When you start to regain trust, you can start to then regain more power over your dividend policy. So when companies say, look, we feel we are being forced to pay dividends, we'd like to accumulate more cash, there's no quick path to get there. You've got to build up trust, and the way you build up trust is by delivering in terms of projects and in terms of stock returns for your shareholders. And over time, you will gain the trust of shareholders so you can start accumulating cash. You go forward to Disney in 2013, Iger was starting to lose the faith of shareholders again. And you can see the 2-year Chapek regime at Disney. Disney shareholders essentially lost all faith in management. Now that Iger is back, the question is how long does he get before shareholders start to get impatient again? Because at this stage, the company's on a fairly short leash, especially with Disney Plus eating up so much in cash flows. Anytime a company does a big acquisition or a big investment, it's putting all its chips on the table, saying, trust us. And you're going to trust them if they have a good history, but if that doesn't get delivered, you're in serious trouble. So Facebook is making a really big bet on the metaverse. It better pay off. Microsoft is making a really big bet on AI. It better pay off, because if it doesn't pay off, the way it's going to show up is going to end up with a decade where you have very little power over dividend policy because shareholders no longer trust you. Any questions? So let's talk about Vale. So this is Vale in 2013. Their free cash flows to equity.
Hey, this is a company I actually own. He says Vale, I say Vale. I don't know what is. I think it's the same company. I think it was a steel company or something. I think I still got it in my Rolf. Iron ore and ore pellets used for raw materials and steel making. That's it. That's interesting to see what he says about it, because the P/E ratio is low. It's got good earnings, and the stock has just gone down. Although in January, someone sold at that peak, they would have done pretty good. Bought at 13 or 12 and sell at 18, they would have made some money. But they're also paying a 5% dividend yield. And this is not a small company, 55 billion. And I had no idea he would talk about this company here. It's just interesting. And the only one stock that my parents owned that I'm aware of, the individual stock, was Disney, and they've owned that for many years. But anyway,
We're negative. Why? Because there are all these different debt payments to make. But essentially, they were already underwater with the before debt payments, after this, so they're already underwater. So we know that a company with negative free cash flows to equity should not pay dividends, and they were paying immense amounts of dividends. And I'll tell you, this is not just Vale. A lot of big Brazilian companies had gotten trapped in this process of paying big dividends, and you're going to see why their free cash flows to equity were negative.
I don't know. Maybe I need to sell Vale after watching this.
So as a Vale CEO, I'm in trouble, right? I'm paying out dividends I can't afford to. So you're going to play the role of Vale shareholders. You can see the trouble I'm in, right? I have negative free cash flow to equity. I'm paying out big dividends. I ask for your permission to cut dividends. Sounds like a reasonable request, right? But there's a catch here that we talked about very early in this class. Remember I said Vale has two classes of shares. Voting shares that are held, a small subset of voting shares that are held by like 7 entities that control the company. All of you at the shareholders meeting own the preferred shares, which get no voting rights. But in return for giving you no voting rights, I also gave you this promise of I'll pay out a fixed dividend every year. In other words, in return for giving up voting rights, you got those special dividends. So what do I want to do? I want to cut those dividends because I can't afford them. Would you demand something in return? I would hope so. In return for no dividends, you'd like to get some voting rights back, right? This is the trap you get into if control becomes the key driver of every decision. So when you ask for voting rights, you know what I'm going to say? No, I'm not giving you the voting rights. I'll keep paying the dividends. This is how you dig yourself into a really deep hole if control becomes the key driver of everything. In fact, if you get a chance, read my post on Petrobras. It's actually, I think, the most negative post I've ever written about a company.
Hey, well, I might have to watch that one next because maybe I need to sell my position in Petrobras now. maybe I shouldn't have looked up this guy. All right, let me type him in here. Um, all right, let me see if I can hear him again. He said something about Petrobras. I'm very interested because the half of my Roth is basically in BAK, and Petrobras owns BAK. And he said Petrobras. He said his post was probably the most negative he's ever done.
So as a Vale CEO, I'm in trouble. I'm paying out dividends I can't afford to. So you're going to play the role of Vale shareholders. You can see the trouble I'm in, right? I'm negative free cash flow equity. I'm paying out big dividends. I ask for your permission to cut dividends. Sounds like a reasonable request, right? But there's a catch here that we talked about very early in this class. Remember I said Vale has two classes of shares. Voting shares that are held, a small subset of voting shares that are held by like 7 entities that control the company. All of you at the shareholders meeting own the preferred shares which get no voting rights. But in return for giving you no voting rights, I also gave you this promise of I'll pay out a fixed dividend every year. In other words, no, in return for giving up voting rights, you got those special dividends. So what do I want to do? I want to cut those dividends because I can't afford them. Would you demand something in return? I would hope so. In return for no dividends, you'd like to get some voting rights back, right? This is the trap you get into if control becomes the key driver of every decision. So when you ask for voting rights, you know what I'm going to say? No, I'm not giving you the voting rights. I'll keep paying the dividends. This is how you dig yourself into a really deep hole if control becomes the key driver of everything. In fact, if you get a chance, read my post on Petrobras. It's actually, I think, the most negative post I've ever written about.
I'm not sure where his post on Petrobras is. I agree with him on Apple. I don't think Apple is. Um, this one's probably a positive a positive video on Petrobras. I'm interested on finding that one about 28 minutes and 40. This would be interesting to look at this one with the country risk, because to me that's the biggest risk in Brazil is the country could default. And here's another video on the country risk. Sorry guys, I'm just looking to see if I could find whatever video he's talking about. And maybe it's not on his channel, maybe it's in some private group or something.
Trust gets shed. In this case, when the vote was put to the Microsoft is making a really big bet on AI, it better pay off, because if it doesn't, in relaundering this process year, dividend policy connected back to your strange rationale. But let's assume you're in an economy or a market where the government mandates a dividend policy. Every money-making company is required to pay out 30% of its earnings as dividends. Let's talk about what kinds of companies in that market will be.
I just want to hear this real quick about the Apple stuff.
Professor of Finance and Valuation at Stern School of Business in New York University. He appeared in the shareholder meeting with Warren Buffett and Charlie Munger. I'm not sure if you guys noticed it. And he's kind of been given the name the Dean of Valuation. I don't know who gave him that name, but he's known as the Dean of Valuation when it comes to valuing stocks. And Warren Buffett and Charlie Munger, well, I kind of call them the kings of valuation.
Charlie can comment.
I'll leave him in one comment first, but Charlie will come on.
Templeton Way podcast, Professor Damodaran, who he respects almost as much as Warren and Charlie, mentioned that he is not comfortable with positions becoming a large part of his portfolio. For example, when they reach 25 to 35%. He mentioned that Apple is now 35% of Berkshire's portfolio and thinks that that is near a danger zone. Wonders if Warren and Charlie can comment.
I'll leave him in one comment first, but Charlie will come up with.
I think you thought it was mine.
Yeah, I knew that was coming.
One of the inane things that's taught in modern university education is that a vast diversification is absolutely mandatory in investing in common stocks. That is an insane idea. It's not that easy to have a vast plethora of good opportunities that are easily identified. And if you've only got three, I'd rather be in my best ideas instead of my worst. And now, some people can't tell their best ideas from their worst, and in the act of deciding that an investment already is good, they get to thinking it's better than it is. I think we make fewer mistakes like that than other people, and that is a blessing to us. We're not so smart, but we kind of know where the edge of our smartness is. That is a very important part of practical intelligence. And a lot of people who are geniuses on IQ tests think they're a lot smarter than they are. And what they are is dangerous. And But if you know the edge of your own ability pretty well, you should ignore most of the notions of our experts about what I call diversification of portfolios.
Charlie Munger, 99 years old, and he's still as sharp as ever. I want to know what keeps him so sharp. What is his secret? Constantly reading and constantly learning. Essentially, was that Berkshire has gone too big into Apple stock. They weren't diversified enough. And Munger said that this is stupid, and here's why. I want to break down what Munger said and to identify a good stock opportunity. In 50 years, I found one investment opportunity in Barron's, out of which I made about $80 million with almost no risk. One opportunity, 50 years, coming from a high IQ, disciplined genius who basically business punch card, that's what he calls it. But the point is, when you do truly understand business, he says this is a problem with a lot of investors, not necessarily aswath, but in general, they just...
Apple is not 35% of Berkshire's portfolio. Berkshire's portfolio includes the railroad, the energy business, Garanimals, you name it, See's Candy. They're all businesses. And, the good thing about Apple is that we can go up. To think that our criteria for Apple is different than the other businesses we own. It just happens to be a better business than any we own. And we put a fair amount of money in it, but we haven't got more money in it than we've got in the railroad.
Okay, so Aswath read the information wrong on Berkshire, and it's a very easy mistake to make. A lot of investors make this mistake. But if you go on any website, on Google, and you look up Warren Buffett's portfolio at Berkshire, in this case, I'm going to use Datarama, that's the normal site I use. It says that Apple makes up 39% of his portfolio. So isn't Aswath right and Warren Buffett wrong? No. The reason is these websites just show the public USA stocks that Buffett has. It does not include his privately owned companies, particular interval of cash. So yes, out of all of his public USA stocks on the stock market, Apple is worth 39%. But Buffett at Berkshire wholly owns all of these other great businesses like Geico, Dairy Queen, BNSF Railway, Berkshire Energy, etc. So you need to include these in addition. So if you go into Berkshire stock and you look at their $107 billion in total, Apple is worth $116 billion. That's how big a size Buffett has, Berkshire has. This makes Apple worth 22% of his total portfolio, not 35%. And with the calculation, I'm not even sure if you would include PPE as long-term investments. Maybe someone in the comment section can answer that below. If you did include that, then Apple would be a whole lot even smaller than 22%.
I want to hear this one real quick.
Petrobras is an interesting but unusual company, at least from Western perspective. So let's analyze this biggest Brazilian oil and gas company, value it, and see, is it an unexpected investment possibility or just a company with 1.5% year over year? Income is down by 14.8% year over year. Cash went up in the last quarter by 28.7%, so that is quite impressive, and debt went down by 0.4% in the same time. Those results are far too little to understand where this company is at. So let's take a look at the big picture. Individual insiders, that is an X with 0% of the company owned by individual insiders. And like I said before, almost all of the management and board of directors are in the company for less than a year. So basically, after the presidential elections, everybody got fired and trusted people got some well-paid positions. Now, that usually is not the best scenario for a company. So, of course, individual insiders are not buying. And are there any super investors that own this company? That is a check with one super investor, and it is no other than Howard Marks of Oak Tree Capital Management. And this investment makes almost 1.1% of his portfolio, so it is not anything huge, but he made a lot of smaller investments as well. And is he buying right now? That is a check. In Q1 2023, Howard Marks bought over 350,000 shares of Petrobras, adding 4.6% to his position. Return on invested capital, that is an X at 2.4% 10-year median returns. We usually can use this metric to assess the management, but in this case, the management changes after every election, so past results are not very helpful. And free cash flow growth, that is a check at 34.8% 10-year compound annual growth rate. So this result is extremely impressive. And what do we know about net profit margin? It is a check at 29.4%. And when we look at its competitors, we see that BP has a net profit margin of 10.6%, Shell 11.4%, and when we compare it to the two companies that Warren Buffett owns a part of, Chevron has a net profit margin of 15.3%, but Occidental Petroleum has an incredible margin of 36.3%. So Petrobras has a surprisingly strong position on the market. And now let's take a look at share buyback. It is an X, but it is also a check. Basically, we see no changes in the amount of shares outstanding in the last 10 years, and that is pretty unusual. And what do we know about the debt? It is a check. It would take just over a year to pay the debt with a 5-year average free cash flow. If we would compare it to the current free cash flow, it would be almost twice as fast, so they have the debt under control. The dividend yield is 57.9%, but it is very unpredictable. Last year, the dividend was $6.44 per share, but they pay dividends based on their cash flow, so it changes every quarter. And they announced that they will most probably change their dividend policy, or as they named it, they will improve it in the near future. And we really don't know what that can mean. And what do we know about the payout ratio? It is an X at 112%. But again, it changes all the time, so it is really hard to predict anything with this company's dividend. And what about the dividend growth? It is an X. It is not a stable annual or quarterly dividend, so we can't see any growth. We will have to estimate a growth of Petrobras for the next 10 years, and we will make 3 scenarios of this growth. So in the low...
Yeah, and like I said, this is a very not accurate way of evaluating companies, but I will entertain it just for giggles.
Scenario, we will estimate a decline of 5% and then a decline of 10%. In the medium, a decline of 3% for the first 5 years and then no growth. And in the high scenario, no growth and then 2% growth. The main reason for such conservative estimates is the fact that it is still uncertain how well this company will do in the future, since Brazil's economy and political situation remains unstable. So I prefer to take the conservative approach. And with such estimates, the intrinsic value in the low scenario is $20, in the medium $30, and in the high scenario $36. But we have to always add a margin of safety to those prices. I use a 30% one, and such a margin gives me enough room for mistakes. I can be wrong with my estimates and still not get myself in any serious trouble. So with such a margin we get, in the low scenario, $14, in the medium, $21, and in the high one, $25.
Well, that's pretty good. He's giving himself a 30% margin of safety, and as you can see, let me see. It's at 14.
And the current price is around $11. So it is all in the green. This company seems very cheap. So most probably the uncertainty of its situation and its future is already priced in. So we have here a fairly healthy company that is doing okay even with a lot of changes to the management, that is paying an unpredictable dividend, and that is very well priced. But we also know that the government can change things around at any moment. So if you know more about the political situation in Brazil, then you may use it to your advantage and see if this is an interesting opportunity or is it just a risky bet. The amount of unknowns and questions that I just don't know the answer to is so big that it is a pass for me even at those prices. But tell me in the comments, what is your view on
Are you ready for retirement? Our free retirement planner shows you where you stand now.
Today we're going to look at another stock that I've gotten a lot of requests to go over, which is Petrobras, ticker PBR. They're a Brazilian company that explores for, produces, and sells oil and gas in Brazil and internationally. Petrobras engages in prospecting, drilling, refining, processing, trading, and transporting crude oil from producing onshore and offshore oil fields. They have expertise in deepwater and ultra-deepwater exploration and production as a result of being in business for more than 50 years. They're also one of the largest publicly traded companies in Latin America with over 45,000 employees, and they have a market value of $89.9 billion US. Their stock trades on the New York Stock Exchange, and it has since the year 2000. And as I'll go into more detail, this is a company that's been through some pretty big changes and some pretty serious scandals over the years. But currently their stock trades for $11.40 per share, and as you can see, it's currently offering an insanely high dividend yield of 56.7%. I'm assuming this is the reason why so many people have been asking about this stock, since I'm sure people haven't just all of a sudden become interested in Brazilian oil and natural gas companies. The huge dividend yield was a good indicator to me that upon first seeing this stock that it was probably either an energy company or a shipping company, both of which have been paying out some massive dividends this year. But at 56.7%, this should be a red flag that something's going on, because even a lot of companies like REITs and BDCs, which are required to pay out 90% of their earnings in the form of dividends, don't offer yields anywhere close to this much. So let's take a deeper look into this company and try and determine if this is a good investment worth considering. Here in the US, Petrobras is an ADR stock, which stands for American Depository Receipt. All this means is that it's a foreign company that's been given permission to trade on a US stock exchange. So right off the bat, this is going to come with some additional considerations to keep in mind that you wouldn't have to worry about if you were investing in a US company. Probably the biggest consideration for investors like us would be the dividends that we receive and how they're taxed. Some countries actually don't charge additional taxes for investors located in the US, but some do. You can also get tax credits depending on the country the business is located in. A second thing you'll have to take into consideration whenever you invest in an ADR stock is just everything going on inside of that country.
I will say the ADR tax is very minimal in my experience. It might be 2-3 pennies or something. But the dividends that I've received are in the hundreds, you know. So the taxes on the ADR is pennies, and you're still getting hundreds in dividends.
In Petrobras' case, they've seen their fair share of controversies over the years. If you're interested, there's an in-depth documentary that talks about this company's scandals that was made by Vox a few years ago. I'm not an expert on the Brazilian oil market or the political landscape over there, but I do know that Brazil is getting a new president on January 1st. This guy, who I wouldn't be able to properly pronounce his name, but people call him Lula, is currently the president-elect of Brazil and will take office on the 1st. He was president between 2003 and 2010, and just recently he was re-elected back into office. Lula's a left-wing politician, and although he wasn't big on clean energy during his first time being president, he has been more focused on environmental issues. So this is obviously going to be a concern for this company once he takes office. The current president of Brazil actually had the CEO of Petrobras fired earlier this year after he was ordered to sell fuel at discounted prices. The company CEO said that he didn't want to do this because it would cause a lot of chaos and fuel shortages. So President Bolsonaro had him fired, which he has the authority to do because this company is actually a state-ran company. Bolsonaro had actually fired 2 other CEOs before this current CEO over fuel prices, which is pretty crazy. Once Lula takes office next year, he has announced that he is replacing the management team yet again. It's worth keeping in mind that the Brazilian government actually owns about 36.61% of all this company's shares. So with all this being said, to be invested in PBR would require you to be knowledgeable with what's going on in Brazil and the policies that they have over there. Just by looking at this stock's dividend history, we can see a really inconsistent pattern of distributions. This company's paid dividends every quarter this year, but they only paid 3 dividends in the previous year. Between 2015 and 2017, this company actually didn't pay any dividends to any shareholders. The reason for this change was because late last year, Petrobras announced that they would be changing their dividend policy after successfully bringing down their debt. In their securities filing last year, they announced that they had reached their 2022 target of bringing down their gross debt to under $60 billion already in the 3rd quarter of that year. So until further notice, this company said that they will continue to pay out quarterly dividends. But judging by just how different each dividend payment is from one quarter to the next, PBR isn't going to be an ideal holding for someone looking to live off dividends. We can see they paid $2.60 per share in dividends back in August, but they only paid 65 cents per share the next quarter. It's really similar to how other energy and shipping companies are. Royalty trusts, for example, are energy companies whose dividends depend solely on the performance of oil. When prices are high, they pay more dividends, but when things start to slow down, then they cut their dividends. For investors who are retired and looking for more consistent income to live off of, they shouldn't invest too heavily in energy or shipping stocks. They should instead look for holdings like REITs, BDCs, and closed-end funds. While their stock is currently up for the year, it recently went through a sizable decline a few weeks ago. Between October 21st and today, the share price of PBR fell by over 28%. The share price decline was blamed on Lula being elected in Brazil's general election, where he had received roughly 50.9% of the vote. But despite that, their stock is still up a little over 2% for the year, which doesn't include those massive dividend distributions, so that would also boost their stock's total return this year. Since their IPO, the stock's been on a roller coaster during certain periods, reaching an all-time high back in 2008. I'm not knowledgeable with Brazilian history to know what was going on back then, but Lula was in office when this stock reached its all-time high. There was a 2-for-1 stock split that year, and it was a year where they paid 4 quarterly distributions, so there probably was some good performance that year. In terms of looking at where this company is today, there are a few things in their latest investor presentation that do look promising. First off, as mentioned earlier, this company does continue to make a lot of improvements with their debt. Over the past few quarters, they have been bringing down their debt by quite a bit up until this recent quarter. And remember, this is even with those massive dividends this company started paying a year ago taken into consideration. So overall, Petrobras has been in a pretty healthy position financially. One concern I do have though is that their long-term debt does have a financing rate of 6.4%, which I'd consider to be pretty high in terms of long-term debt. Even though their last quarterly dividend was a dramatic decrease from the previous one, they still appear to be in a good financial position for the time being. Petrobras has also been making moves in terms of developing new markets for their oil sales. In the 3rd quarter of this year, the majority of all their exports were to China and various countries throughout Europe and Latin America. They saw a 24% increase in jet fuel sales compared to the 3rd quarter of last year, and they reached 14 authorized sites for oil and oil product transshipment operations in Brazil, which increased their operational flexibility. All in all, this is good news for the company, which is also touting some big environmental campaign that all these oil companies seem to have going on. As always, I'll let you decide for yourself how serious these companies actually are about achieving a more environmentally friendly process of doing business. Overall, this is kind of a difficult company to assess. Obviously, the government's interaction with the oil industry, and specifically this company in particular, is concerning since Lula will have so much power over it. Given how much the company's been paying in dividends and the fact that their largest investor is the government leads me to believe that there's evidence that these dividends could be here to stay, just as long as this company can keep its debt down and post good returns. On the other hand, I don't know what Lula's thoughts are concerning profits being distributed to shareholders outside of Brazil. I don't know if he's trying to keep money from leaving his country like I know a lot of world leaders seem to care about. The biggest concern investors need to have is Lula entering office next year. I don't know much about the guy or his track record, so I'm not going to speculate on how things are going to be after he takes office. But anytime you have a politician who can exercise so much power and authority over a company does make me nervous. If the president wants to lower oil prices, then he can do that. If he wants to fire the entire board and alter their plans, then he ultimately will get his way. If you couldn't tell, Petrobras is a company that makes me way too nervous to consider for my own portfolio. I typically don't like investing in energy stocks such as royalty trusts and master limited partnerships in general because they are cyclical businesses and their dividends can swing a lot from month to month or quarter to quarter. I'm just not knowledgeable enough with what's going on in Brazil to where I feel like I could make a well-informed decision on this company. Energy stocks like Petrobras are usually best for trading in the short term. There's certain time spans of a few months or a few years where holding these kinds of stocks can be really profitable, but actually holding them for a long period of time, like decades and decades, usually...
So he doesn't really like it. This kid looks like he's 5 years old. But I mean, that's the reason it's trading at 2 times earnings or 3 times earnings is the risk. I mean, yeah, there is there is a risk for investing in Brazil. I mean, if the country defaults on its debt, you know, that could be a risk. But I think the risk is worth it. But I would be interested to hear what this guy has to say about it. And I would like to be able to find that because I mean I don't think this guy's right about everything, but he is a good. And it's okay if value investors disagree. You know, one of the videos I talked about earlier, Bruce Greenwald had debated somebody about John Deere when it was $75, and the guy thought it was going to $25, and now it's I don't know. Let's look up Deere, see what Deere is. 200 and some, almost 400. So you know, if they would have, you know, when it was probably in here when he was debating about it, thinking it was going to go down to $25, and then it's gone from 60 to 400. So and the PE ratio is still not bad, 11%, paying a dividend. Earnings per share, not bad.
With NFL Sunday Ticket on YouTube, you can watch your favorite teams out of market.
Of my little series about PBR. I made a similar video like this one a few weeks ago, and if you guys didn't, and it's currently paying about a 65% dividend according to Yahoo Finance. So I recently bought just under 1,000 shares before the ex-dividend date that happened on April 28th. And since then, I've not only bought more shares, but I now have 3 dividend payments scheduled for this year, and we'll look at that in just a minute here. So Petrobras is one of the largest oil producers in the world, and it had a record year in 2022, and even though 2023 might not be as lucrative of a year as 2022, the dividend payments this year are at least something to talk about. So like we saw in the previous video I made about PBR, it paid a little over $6 a share in dividends, but that's mostly the result of how well oil and energy stocks performed last year. It seemed like every other company took a massive beating last year and had to do mass layoffs and things like that, but oil and energy stocks were just skyrocketing for basically the entire year of 2022. So PBR being one of the biggest oil and gas companies in that sector, it saw massive profits last year and then paid out those profits in the form of dividends, which is why those dividend payments were so high. And this year so far, it's looking like PBR is continuing to perform fairly well and might keep doing so throughout the year, especially if oil prices remain elevated. So pulling up my position in PBRA, as you can see, I have a little under $11,000 invested, and the stock actually jumped about 4% yesterday, and I'll talk about that in a minute here. But that makes my capital return just under $1,000, as you can see. And I've only owned this stock for about 2 months, just under $1,000.
You can see his dividends here. So he invested $10,000. He said that's 5, 6, 7, 8, 9, 10. So you know, I mean, he's invested $10,000. He's already got $1,000 in dividends. So I mean, that's 10% right there. You know, that's good. It's a good thing.
Capital return just under $1,000, as you can see. And I've only owned this stock for about 2 months now, so that return is pretty decent, but that's still not including the upcoming dividends that I'm scheduled to receive. So because I owned shares of PBR before the ex-dividend date on April 28th, I'm now obligated to 3 different installments, as you can see, with the first one being paid out in just a few weeks here on May 26th. And that first payment is $529.54, or about 57 cents per share. Now, I currently own over 1,000 shares right now, but remember I owned 922 shares before the ex-dividend date, so any shares purchased after that date won't count towards these upcoming dividend payments. And then this next one in June was actually adjusted a little bit recently. So a couple days ago, the amount was supposed to be $500. Then a few days after that, it just disappeared. And I was kind of worried because it wasn't showing up at all on Robinhood. But then yesterday it updated and was back and adjusted to $335.75, or 36 cents per share. Not really sure why it was adjusted, but it's a few $100s less than it was just a few days ago. And then this last one is kind of interesting. It's a payment of $192.37, or 20 cents per share, for all the way in January of 2024. So with all 3 of these payments, I'm getting a total of $1,057 for about a $9,000 investment, but that's just the first round of dividend payments for this year. There should be at least 3 more dividend announcements this year, and they usually announce the amount per share as well as the ex-dividend date after they report their quarterly earnings. And this is one of the reasons why the stock jumped up yesterday. So on Thursday after hours, the company announced their Q1 earnings, which were better than expected. And then they also announced that they're planning on paying out $5 billion in dividends this year, as well as the possibility that the company might be buying.
You got to remember, this isn't $5 billion. Well, I don't know. Maybe it is $5 billion in U.S. dollars, but it might be $5 billion in whatever the Brazilian currency is. But anyway, this video was 3 months ago.
Buying back shares, and those are 2 pretty bullish signs. So when it comes to my position in this stock, despite all the good news, I'm actually
This one's a short one, 5 minutes. This looks like a little kid.
Hey, my name is Tucker Krause. Welcome back to my channel. In today's video, we're going to be looking at Petrobras. Yeah, I know it's been a bit. Petrobras trades with the ticker PBR. It has a share price of $12.06, a market cap of about $80 billion, a very low PE ratio of 2.12, and obviously that dividend, I think that's why most people are interested in that stock. You can see it right there. Though I should note the preferred shares trade as PBR-A for a slight discount, allowing for higher dividend income. So roughly right now, at least as of April 15th, for every 100 shares of PBR, you get about 112 shares of PBR-A, and so you're not necessarily going to miss out on any upside potential, but obviously the main idea there is because you'll be getting whatever it is, about $8 per share. You'll be getting, 8 times 12. I don't feel like doing that math right now, even if it's simple math. Yeah, you might think, hey, is this dividend really sustainable? Well, as of now, at least PBR is currently planning for that to be the case. As we can see in this tweet right here, PBR really did just telegraph today in the 20F that that they're keeping this 60% payout policy. So if PBR manages to make the same amount of money every single year for the next 4 years, that means that dividend is going to stay just as high as it is today. Not to mention, say oil price, climbs back up again, because obviously it's fallen off a little bit. So far this year, again, they haven't released any results, but there's a good chance that their overall income, yes, is a little bit lower so far in 2023 than 2022. That's their lowest revenue. 2015 falls off a cliff. Wouldn't you know, they're an oil company. And so, yeah, as I was mentioning earlier, right, 2022, very high, 2021 increasing. So chances are I wouldn't be surprised if our revenue number for this year ends up being closer to 2021 if oil does it pretty good, at least until, the later half of 2014. It's still a negative free cash flow. But the reason for that is because operating cash flow from 2013 to 2020 was incredibly consistent, around $26 billion US dollars, with the main difference being capital expenditures when it came to free cash flow. So pretty much it would be like, 2013 and 2015 had almost identical operating cash flow, but it's because they were doing this, and in both cases, very effective return on equity, well above the S&P 500 average, and their return on invested capital, well above the weighted average cost of capital. And so the interest expense ratio and debt to earnings ratio are representative of their debt. And so interest expense ratio at 17.17 essentially means that their EBIT is about 17 times their interest expense. So that shows us they aren't just some zombie company that's sitting here drilling oil and, just basically living to service their debt. Same thing with debt to earnings ratio. A 1-to-1 would indicate that their net income and long-term debt is equal, though in this case it's 0.72 because their net income is greater than their long-term debt. So essentially, if they really wanted to, they wouldn't be crushed by their debt is the most important thing here. So overall, all these management numbers very quite strong. And here's just a little bit more on the balance sheet. The quick ratio and current ratio are representative of current balance sheet strength. So the current ratio is essentially just current assets versus your current liabilities. In that case, they're 1-to-1. Quick ratio takes a few things away from your current assets, 0.72. Ideally, it should be 1-to-1 or better. It's kind of different here with PBR, just, depends on the type of company, because it's going to be very different when you're looking at the fairly overpowering. Now on to the DCF. So at their weighted average cost of capital, 9.43%.
I'm glad he said that, because I forgot what WACC was. Weighted cost of capital.
At their weighted average cost of capital, 9.43%.
Weighted average cost of capital.
They have massive upside, an 8% rate or 10% rate, doesn't matter what you do, massive upside here. Now, it does seem a little bit ridiculous, because we're just going to refer to that $72 fair value from here on. So a little bit over the top, because this would give PBR a market cap around the size of Exxon today, but not totally incomprehensible, as this would only give PBR roughly a 12 PE ratio. And so to maybe look at something a little bit more realistic then, Exxon has a 8.75 PE ratio, and PBR has roughly a 2.15 PE.
Hey, I'd be happy if PBR goes to 50. I think some of you guys would.
Ratio. So it would be roughly $50.
But you want to accumulate the shares first, though, right? Before it goes to 50.
If it had a PE ratio equal to Exxon. But of course, like less jurisdictional risk for the most part with Exxon. So even if it's not exactly 8.75. So it's not to say rush out, buy the stock immediately, because of course you should do your own research, because this is not financial advice. This is just what I found myself. So this should have absolutely zero effect on your opinion of the stock. Do your own research. Thanks for watching, and I will see you next.
I don't know what happened to my... I'm going to get that guy a like.
Introducing the new 2024 GMC Sierra HD.
Hey, my name is Tucker Krupp.
Hey, that guy did pretty good. It looks like a girl, but I guess it's a guy.
Hey, my...
This video, I'm going to walk you through the process of valuing Petrobras' stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Petrobras operates in 3 business areas. The first, let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures.
Okay, granted, like I said, this is it's if you're off just by a little bit, like 1 percentage point, you stretch that out 20 or 30 years, I mean, you're just off totally. But I'll entertain it. Let's see.
Look at that free cash flow growth from 1.7 billion way up to 40 billion. That's just unbelievable growth. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's gone from 8 billion up to 37 billion. Revenue is the sales for the company, and that's grown a lot as well. It did drop from 2019 to 2020, but then grew a lot from 54 billion to 125 billion. This is the company's income statement. The top line is the revenue, the sales. Their revenue in 2022 was 125 billion. Let's dig into that number so we know what it represents. Of the 125 billion of revenue, 76 billion was from oil products, 40 billion from diesel, 16 billion from gasoline, 5 billion from liquefied petroleum gas. Jet fuel is pretty big at 5.4 billion. Naphtha, 2.4 billion. They generated 7.7 billion from natural gas, 7.7 billion from oil. So in Brazil, they generate 94 billion of revenue. Outside of Brazil, they generate 30 billion. Of the 30 billion of foreign revenue, 19 billion is from oil, 7.4 billion from fuel oil. Their revenue and profits are highly dependent on the price of oil. When oil prices go up, so does their revenue and profits. Here's a breakdown of their revenue by country. 94 billion in Brazil, 7.2 billion in South America, 6.4 billion in China, 5.9 billion in Europe, 4.9 billion in the United States, 4.3 billion in Singapore, and 1.5 billion in all Asian countries, excluding China and Singapore. Let's go back to their income statement. Below revenue is cost of revenue. These are the expenses directly related to generating the revenue. An example of something in cost of revenue is a cost to buy the petroleum and the fuel. Revenue minus cost of revenue gives you your gross profit. Their gross profit margins are above 50%. The way you calculate gross profit margin, it's gross profit divided by revenue. It's how well you convert revenue into gross profit. And that doubled from 2019. It grew about 50% from 2021. Then you have operating expenses. These are all the expenses not directly related to generating revenue. An example of this is their payroll for their executive team. Gross profit minus operating expenses gives you your operating income. And that tripled from 2019 to 2022. They spent 2.8 billion of interest on their debt, which is a lot lower than prior years. It was up to 6.3 billion in 2019. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. It looks like they had a really big asset impairment in 2020 of 11 billion. That's why their net income was so low. Then your pre-tax income, your taxes, and the bottom line of the income statement is your net income. You notice as you get lower in the income statement, the growth is more exaggerated, because on the top of the income statement is revenue. Their revenue growth from 2019 to 2022 was about maybe 60-70%. Their gross profit growth from 2019 to 2022, to 31 billion to 65 billion, was a little over 100%, maybe 110%. Operating income growth, the 18 billion to the 55 billion, that was about 200%. And the net income growth, the 8 billion to the 37 billion, was about 400%. So as you go lower on the income statement, the growth gets more exaggerated. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So their cash flow doubled from 2019 from 26 billion to 49 billion. Then your capital expenditures, investments in property, plant, and equipment. They spent a lot on CapEx in 2019, 24 billion. Operating cash flow minus CapEx gives you your free cash flow. And that's grown a ton from 1.7 billion to 40 billion. And they've been paying down lots of debt. They paid down 15 billion in 2022, 27 billion, 32 billion, and 32 billion. They do add debt each year, but not nearly as much as they're paying down. That's why their interest payments on their income statement were so low in 2022 compared to prior years. Let's look at the capital structure. 69 billion of equity, 54 billion of debt. They're 56% equity, 44% debt. And their net debt is 43 billion. So it looks like they have about 10 billion of cash on their balance sheet. I gave them the highest whack on Finbox, 15.3%, and that's the discount rate we're gonna apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's 135 billion. We discounted those numbers back to today using a weighted average cost of capital. We get a value of the company of $159 billion. We divide that by 6.5 billion shares. And we get a calculated stock price of $24. They're trading at $10, so they're trading at a 57% discount. It's a really strong buy according to the...
So this guy's, his price is $24.
Model. 9 analysts projected their future revenue for 2025, and their target was 500 to 1 billion Brazilian reais. When you convert that to US dollars, that's 100 billion US dollars. Their revenue target for 2024 is 99 billion. 2023, it's 107 billion. I continued this trend into 2026 and I got 102 billion. That's how I got their future revenue estimates. And they convert on average 28% of their revenue into free cash flow, so I multiplied their future revenue estimates by 28%. That's how I got their future free cash flows. The website Simply Wall Street values the company at $20 a share. They're saying it's 47% undervalued. 3 analysts priced this stock and the average price target is $12. The low is $11.50, the high is $13. This is where the stock has been trading the last 5 years. So it was up to about $20 a share before 2020. Then during COVID, it dropped like a rock, like most other stocks, including oil stocks. It was down to $5 at its lowest point. Then it got past $15 again at the end of 2022. But it's dropped a lot since that point, sitting around $10. In the past 5 years, this stock is down 26%. In the past 5 years, Brent Crude and West Texas Intermediate are both up about 16.5%. I guess this stock isn't doing as well as oil because they pay such high dividends. If they didn't pay these dividends, the stock price would do a lot better. They pay some wacky dividends. Look at the amount of dividends they paid the past few quarters. $1.30, $2.59, $1.47. If they continued paying $1.30 dividend, their dividend yield will be 50%, which is 84% of their free cash flow, 92% of their net income. Here's a chart of their dividend yield since 2012, and the forecast is for their yield to be 12% by 2025, which is still a really good yield. They have a beta close to 1, so the stock moves with the market. It's down 31% in the past 52 weeks, while the S&P is down 10%. The 52-week low is 9, the high is 16. The stock is on a downtrend, trading below its 50-day and 200-day moving average. This is a really popular stock. About 20 million shares are traded each day. Of the 6.5 billion shares outstanding, 4.1 billion are on float, 22% held by institutions, and 0.5% of the shares are shorted. They've done 2 stock splits, a 2-for-1 in 2007 and another one in 2008. If you invested $10,000 into this company 10 years ago, you'd be in the red most of the time, but if you kept holding on, you'd be at $13,000 today. That's a 3% annual return. 37% of the company is held by institutions, 29% by the Brazilian government, 26% by the general public, 8% by venture capital and private equity firms, and a really small percentage by private companies. They do employ 45,000 people, but that's been going down over the years. They were close to 70,000 people in 2017. That's generally not a good sign when the employee count goes down a lot. Their biggest shareholder is the Brazilian government, which can be a concern for some people. They own 29% of the company. Their second biggest shareholder is the Brazilian Development Bank at 8%. Then GQG Partners, this is a Florida investment firm, 5.5%, BlackRock at 4%, and Vanguard at 3%. The best way to look at ratios to compare them to companies in the same industry, there are 11 companies in the same industry as Petrobras, and if Petrobras has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They do spend more than average CapEx, 10 billion, average is 6.5 billion. They are a bit more leveraged than the average company, but they are paying down lots of debt year after year, so they're trying to get that number more in line. They pay a crazy high dividend. They generate lots of free cash flow, more than BP and Total Energies. and a little less than Chevron. But the reason their market cap is so much smaller than the other companies is because Petrobras is Brazilian, and there's a country risk that's associated with Brazilian companies and certain countries. BP is British, and that's not a risky country. Total Energies is also British, and Chevron and Exxon are American. They have amazing ratios, really, really good. Once again, because they're a Brazilian company and the market cap should be a lot higher, but it's not. That's why their ratios look so good. They generate lots of revenue, more than just about anybody on this list, relative to their market cap. But of course, they generate less revenue than these monsters.
One more. Let's leave one more.
Did you ever stress about us having 3 kids?
No. I was always part of the plan.
Hi, can we talk? We asked you to give us ideas for stocks to do analysis.
They produce a product that people have to have.
Yeah.
As far as the finances go, their net income, if you look at their operating income, their cost of revenue, their gross revenue, their assets, their liabilities, if you get into all of those things, the business itself looks relatively stable. In fact, the last 5 quarters, you can see that their net revenue went up. Now, their cash flow is going down. Some of that has to do with litigation and the corruption side of it, but others of it has to do with renewable energy.
Right.
They're digging into biofuels and a lot of the renewables that you see
solar, wind, and they're really doing a lot of research with the new management due to the corruption to get away from that.
I'm sorry, guys, but these 2 dudes look like the 2 dorkiest. Look at these guys. These look like the 2 dorkiest people I think I've ever seen in my life. I hate to say it.
Due to the corruption to get away from that mindset of corruption, and they're really doing a lot of...
Do you know, I don't know what that growth is on the side of his face. I gotta listen to this.
Take this quarter. Go downtown and have a rat gnaw that thing off your face. Good day to you, madam.
This is the fool.
I'm Anita Horgarth.
Buck melanoma, Molly Russell's wart. Not her wart, not her wart. I'm the wart. She's my tumor, my growth, my pimple. I'm Uncle Wart, just old Buck Wart Russell. That's what they call me, or melanoma head. They'll call me that. Melanoma head's coming. Uncle. Maisie Russell's uncle. I'm her uncle. Her mother set up this conference with you.
I'm assistant principal here, as you've probably noticed from the indications on the door.
This door?
The outer door.
The outer door?
Yes.
Because there's nothing on this one.
That's just about enough of that.
Sorry.
I've been an educator for 31.3 years, and in that time, I've seen a lot of bad eggs. I say eggs because at the elementary level, we are not dealing with fully developed individuals. I see a bad egg when I look at your niece. She is a twiddler, a dreamer, a silly heart. She is a jabberbox. And frankly, I don't think she takes a thing in her life or her career as a student seriously.
She's only 6.
That is not a valid excuse. I hear that every day and I dismiss it.
I don't think I want to know a 6-year-old who isn't a dreamer or a silly heart. And I sure don't want to know one who takes their student career seriously. I don't have a college degree. I don't even have a job.
Does anyone have a special story to tell the class about something that happened this week? Maisie.
My uncle was microwaving my socks and the dog threw up on the couch for about an hour.
Honest?
Yes.
Why was your uncle microwaving your socks?
Can't get the goddamn washing machine to work.
Blasphemer! But I know a good kid when I see one. Because they're all good kids. Until dried out, brain-dead skags like you drag them down and convince them they're no good. You so much as scowl at my niece, or any other kid in this school, and I hear about it, and I'm coming looking for you. Take this quarter. Go downtown and have a rat gnaw that thing off your face.
Good day.
Oh man, look, what is this right here? What is that thing?
A research with the new management due to the corruption to get away from that mindset of corruption and into a mindset of, hey, we're helping the environment and we're doing all these neat things. So don't look over here. Look over here.
From a financial standpoint, the company doesn't look bad. That's not a bad thing. The dividend, though, is all over the place.
Every day it changes. I look at it. Sometimes it's 50%, sometimes it's 77%, sometimes it's 68%.
They're basically a government entity, not electing the board members and CEO of the business itself.
Right.
So the dividend, is that going to be sustainable? Well, we don't know. That's up to what happens with the entire board and all the executives and everybody. And of this Operation Car Wash, there was over 1,000 arrests made. Now they
more coming up. So there is nothing in their history or in the future that guarantees that this dividend is going to stay. So if you're buying it for a huge dividend, if you didn't get in on that.
All right. Anyway, guys, I'm gonna have to cut it off here. I'm getting hungry. But yeah, I'm curious to see what this guy thinks about PBR. Not that it would change anything. I mean, we know there's a risk. I mean, we know they've had scandals. That's when you buy stuff. You know, you buy stuff when things look bad, when things look ugly, when you know people are having scandals and they just had a new left-wing president elected. You know, all these things, you know, are negatives. So the thing about the management getting switched every year or even more frequently, you know, if the president wants the gas price lowered and the CEO says no, they could fire the CEO, you know, but I think it's just so damn cheap that you just can't ignore it, you know. And you can't tell me that it's not cheap, because anyone with half a brain cell can tell it's cheap. Anyway, thanks for watching. But yeah, this guy right here, he does a lot of evaluations. I don't necessarily agree with him all the time, but he'll try to slap a valuation on Microsoft. He'll try to slap a valuation on Google, Apple. He'll tackle the tough tech stocks and other stocks that someone like Warren Buffett would normally just put in a too hard pile and be like, that's just too hard. I can't value that, you know. But this guy tries to come to you know, uses logic and reasoning and tries to come up with educated valuations, and sometimes he's right, sometimes he's wrong, but yeah, I think anybody that practices valuating businesses, and you know, you learn something every time. And if you keep doing the same thing over and over again over a long period of time, you're going to get better at it. So you're going to learn things about different industries and stuff that you can apply to maybe the next valuation. Anyway, thanks for watching, guys.